Good afternoon, traders. I'm Himalay Bhatia from the Financial Analyst, and I welcome you to the BOLD project. In this module, we are discussing about the Dow theory and its second principle. In the previous episode, we understood that the primary trend is a trader's best friend, and how can we take trades in it by using a secondary trend to spot the corrections and the pullbacks in the market. So, if there's an uptrend, the primary trend is in an upward direction, then we use buy at dip strategy. And if the market is in a downtrend, that means your primary trend is in a bearish trend, then we use a sell at rise strategy with the help of your secondary trends in the market. In this episode, let's talk about what minor trends are. Now, the theory suggests that the minor trend is one of the most unimportant and one of the most useless trends in the market. It says that if a trader places too much focus in this trend, it can lead to a total loss of his capital. Now, why does the theory say so? So, the theory justifies by saying that a trader may get trapped in the short term market volatility and thus it may end up losing the entire capital of that trader. Now, what does this statement mean? How can a trader get trapped in the short term market volatility? So, let me break it down for you. Now, this trend is talking indirectly talking about your intraday traders. All right. It's saying that what the intraday traders do is something which is not the best practice or the best approach to the market. Why is that? So, the first reason being, or let me just give you an example over here. All right. Let's give you two scenarios. In the first scenario, I say that you have to travel to Europe in the next month. All right. Of course, not under the current COVID situation, but otherwise. Let's say that you have to travel to Europe in the next month. Now, how easy or how difficult will it be for you to plan your travel? It will be very easy for you to plan your travel because you have that 1 month's period on your hand. You can look at what the weather is like in the Europe. You can apply for your visa, you can apply for your tickets, you can conveniently pack your bags, prepare an agenda, and then fly off to Europe. All right. In the second scenario, let me tell you, let's say that you have to travel to Europe in the coming few minutes. Now, how difficult or how easy will it be for you to plan your travel? It is next to impossible. Even if you manage to catch a plane, what you will be doing basically is you will be randomly throwing some stuff in a bag, right? And you will just head to your airport. So, what you're doing is, or what sort of a behavior you're portraying is, you are making hasty decisions in the market or uh, in that period over there. So, what has happened is if a person takes hasty decisions, it leads to mistakes, and mistakes lead to losses. So, a similar sort of a behavior is portrayed in the markets as well by the intraday traders. What they are doing, they are trying to determine what will happen in the coming few minutes, and thereby the traders get trapped in this volatility, the small movements that are happening quickly in the market, they get trapped in that, and thus they end up losing a huge amount of capital. Now, how accurate is this point in the current markets, right? Since this theory is about 100 years old, so how accurate is this in the current markets? Now, ever since this theory was established, from there, there have been several studies in the markets. There have been many progress when it comes to your knowledge in relation to your intraday trading. So, intraday trading is something which is not bad. However, we have to consider the risk management part of it. So, let's talk about risk management and money management over here. What do I mean by money management? Now, whenever you invest in the market, what I suggest all my clients is to always divide their capital in the following ratio. About 20% of your capital should go for your investing. That means you leave the stock for about 10 to 15 years or even maybe more than that. All right. Over here, the power that we use is the power of compounding. The second that we can do is 70% of our capital should go for your swing trading. What does swing trading mean? You hold the stock for a few days to a few months. All right. And over here, this helps a trader build a lot of capital in the market for his investments purpose. Finally, about 3 to 5% of your capital should be utilized for your intraday trading if you are interested in it. Why do I say 3 to 5%? Now, what do I mean by 3 to 5%? Only that much amount of capital, wherein even if it becomes zero, it shouldn't bother your financials. All right. So, we will, on an average, break up our capital in this manner. However, don't just blindly follow these ratios. I want you to analyze your own risk appetite, and basis that you can change the percentages over here basis your risk appetite. All right. The second way, now let's talk about the risk management. Over here, we spoke about the money management part. Now let's talk about the risk management part. So there are two major ways to manage your risk in the market. The first is known as by diversifying your portfolio. The portfolio diversification means that we should always and always put our money in multiple stocks. Now, what does that mean? And why should we do that, or why should we follow that practice? The reason being, let's say that we put our money in one stock, all right? And this is more from a swing trader point of view, or maybe even an investor point of view, and less from an intraday point of view. If we put our money in the stock, 100% of our capital. Now, let's say that the market or the stock during the day, during the market hours, was going in our direction of the trade, and we were pretty happy about it. Now, post 3:30, when your market closed, what has happened is there is a big negative news about that stock. What will happen is next day there will be a huge gap down, and maybe there might also be a lower circuit in the market. And in situations like your lower circuit or your panic selling, or even in case of your upper circuits, your orders won't get easily executed and you will be trapped in that trade. So let's say that there is a big negative news, there is a lower circuit followed by a lower circuit followed by a lower circuit. So your majority of your capital has been washed out. That is why we say that we should put our stocks in multiple, we should put our money in multiple stocks. Now, why am I talking about this? If I give you an example, there was a cafe coffee day case. If you all remember, that was last year. If you don't know about it, do a Google search. What had happened was the stock was in its normal uptrend, and post market hours, what happened is there was a big negative news about that company. The news was that the owner of the company had committed suicide, and that is a very big risk to the company. That becomes a company specific risk. And what had happened was for the following few days, there was a lower circuit in the market, and the investors who had put their entire money in Cafe Coffee Day only, they lost a lot of money over there. All right, so I've given you one example, a case study for it. You can do your Google search on that as well. Now, when I say put your money in multiple stocks, what do I mean is not putting your capital in one sector itself, be it multiple stocks. But it does not mean that you put your capital in ICICI Bank, the next should be Kotak Bank, the next should be SBI, the next should be HDFC, the next should be IndusInd. Again, there is a huge risk over here. The risk is that what if the sector itself fails? Again, though your money is in multiple stocks, but if the sector fails, then again, your entire capital is washed out. So what we do is we put our money not in only one stock, in multiple stocks, and not only in multiple stocks, but in multiple sectors as well. And if you have surplus amount of capital, then what I will suggest you to do is not only put your money in multiple sectors, but to also diversify into various segments. Don't put your money in equities only. Put your money in commodities, put your money in forex. Diversify as much as possible. Of course, in a balanced manner. Over diversification is also something which is negative for a portfolio. A balanced diversification is something which is important for an investor, especially, and secondly, a swing trader. Not too much for an intraday trader. Why? Because during an intraday, what is happening? Let's say if you put your money in one stock during an intraday trading. Now, what has happened is a smart intraday trader, what he will do is he will be tracking the news as well. And if there is any negative news in the market, what can happen? What is the worst situation can happen is there is a huge there's a huge gap down. He will still manage to square off his positions because he is live in the market during the market hours, right? He will square off his positions and he has booked smaller losses as compared to your swing trader and your investor. Your swing trader and your investors do not have the opportunity to square off their positions post market hours. And that is why this is a very big risk to them. So this was your second principle wherein we discussed about the primary, secondary and the minor trend. And we also understood that the primary trend is the best trend, the minor trend is the worst trend. And we also spoke about the money management aspect of the markets. And we also covered the risk management part of the markets as well. All right. If you have any questions, please note it down and we will be taking it up in your live doubt clearing sessions. I hope you have a good day. Bye bye.